This video has been prepared for clients of Morningstar Australasia Proprietary Limited and/or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.
All right, let's get into it. So we're going to talk about how to achieve financial independence, and that's part of 3 different independence-related webinars that we're going to do for the rest of July. So hopefully it's a good topic people are interested in. So what does that mean? Well, of course, the concept of independence means different things to everyone. And we did a survey recently. Looking at this is a very poor slide I put together. But anyway, we did a survey recently, and these are just some of the answers that we received. And, really at the end of the day, I think what it demonstrated is that over the course of a lifetime, there are different steps that you take at different times to achieve independence. And it isn't a destination so much as a number of new milestones that you can hit over your investing career and over your regular career and over your lifetime. So I threw a couple up on here. So obviously not worrying about week-to-week financial obligations or unexpected expenses. That's really more around emergency fund, which we'll talk about. Going on holidays every year during retirement. So more retirement-based. High-quality healthcare. So once again, kind of a retirement-based definition of independence. And then finally, the last one, which I think is where a lot of people fall, and it's really the freedom to make choices in life. And really what you're trying to set yourself up for with all of this is you're just trying to set yourself up for opportunities and different options that you can take as your life progresses. So obviously, money can be a factor that does hold you back from not just doing things you want and the traditional way that people define this as sitting on the beach, but also taking advantage of all those opportunities that life has to offer. So we're going to talk a little bit about some different steps. And the first one is relatively basic and really sort of talks about that first option or that first answer that we received during the survey, but also how you can use cash is how you can use cash across your investing lifespan. And, cash is an interesting one because, it does, I think, as I said on the slide, it does have a pretty poor reputation from investors. And there are certainly reasons for that. So there are many people that are very risk adverse and really don't want to stray too far from cash. Cash has the advantage, of course, that it has 0 volatility. So if you have money in the bank, it's not going to go up or down in value. The issue is, of course, it does go down in value when we start taking inflation into account. And you do earn a return on cash. And certainly the returns on cash are looking a lot better now than they looked a year and a half ago. But if we look over the long term, cash has barely beaten inflation over the long term in terms of that return that you're getting from it. And so it's a real reason why cash gets a bad rap from investors. And, if you look at even the better returns that we're getting on cash now, still generally below inflation, even as inflation has come down. And so let's talk about some of the benefits, and let's talk about over the life cycle of investing, kind of how cash plays out. And an emergency fund is really critical. And it's critical, especially when you're young and at any time during your life, is because what we want to do as investors is we want to set ourselves up so that we can make decisions on when we buy and sell things and not be forced to do that. And that's across your investing career. It's when you're young, it's when you're older, so that we can make decisions and not have to sell at times that are inopportune just because we need the cash, right? Or you need that liquidity. And that's why an emergency fund is so important. When you are young, especially when we talk about emergency funds, really what we're talking about is what are those unexpected expenses that may crop up in your life. And when you are young, if there is an opportunity for you to keep your emergency fund on the lower end, that's not a bad thing to do. And, the reason for this is, one, generally when people are young, they don't own things like houses, and a house and unexpected repairs on your house can be a huge drain of cash. Potentially don't own things like cars, which also can be quite expensive if they need to be repaired. And so maybe there's an opportunity for you to keep that emergency fund a little lower and build it up over your lifetime. And the reason for this is, of course, the big thing with cash is the opportunity cost. And the opportunity cost is, of course, where over the long term we can earn higher returns by not being in cash, instead investing in more growth assets where we know we're going to get a better return over the long term, even though they may be volatile. So when you're younger, that opportunity cost is obviously at its height because you have a very long timeline. And that timeline, of course, allows those investments to compound, which is what you're looking for. As you get older, that opportunity cost, of course, declines. So if you have a 10-year investment window, there's not as much of an opportunity to compound as if you have a 40-year investment window. And obviously, as we get older, we start acquiring more things that potentially are going to be sources of cash. Potentially, we have then a family and pets and all sorts of different things where there could be these short-term expenses. So there is the opportunity to build that emergency fund up over time. That is better than obviously spending a lot of time building up a huge one when you were younger. So just something to think about. The last thing I wanted to say about cash, and we spend a lot of time at Morningstar talking about retirement, talking about the transition to retirement, and specifically around this bucket method of asset allocation. And very simply, just as when we're younger, we don't want to be forced to sell investments that we want to keep over the long term because we need to pay for a car repair or something like that. When we're older, we also don't want to be forced to sell investments, but we get into this situation in retirement where we are, of course, forced to sell to pay for living expenses, to extract money out of that retirement account. And then cash can be very beneficial to the ultimate long-term returns you're going to get as you transition into retirement in those early years, because of course you can use cash as a buffer so that if you have the misfortune of retiring into a bear market, then you can use that cash buffer to pay for your living expenses, and that will give you the opportunity for those investments to recover. So just want to clear off on that cash thing first. Cash is really important in terms of independence, really around that emergency fund, and then how we can use cash when we're older to allow us the opportunity to decline from selling when we don't want to. So we have a couple. Lisa says, if cash is king, who is the queen? Lisa, I think you are the queen of the webinars. So that would be you. So Dan says emergency fund is critical. It's a poor reputation because you can't earn big returns, but having to go and borrow money, use credit card is far worse. Exactly. So I was talking obviously about selling investments and the opportunity costs that you're giving up there, but especially if you need to go into debt to cover short-term unexpected expenses, that is even worse because, of course, what we pay for the vast majority of debt we take out far exceeds any return that we can earn. So that's a very good point by Dan. Okay, the anonymous attendee says, "Can you please increase the volume?" I mean, I can try to talk louder, but I can't increase the volume. But potentially, you can increase the volume on your end. So sorry if this is not picking up. But anyway, sorry about that. All right, let's move on and let's talk about how we can build up or how we can work towards financial independence. So let's talk about retirement first. And retirement is obviously something that all of us face. It's kind of a universal goal that we have. So retirement is really, really important to focus on, even for people that say, I'll never retire. Well, you don't necessarily know that. It's great to say that you don't ever want to stop working, but employers have a say around that as well, as does your health and your ability to keep working. So if you are trying to work towards financial independence, the best possible thing to do is to focus on retirement first. And we can talk a little bit about, we'll obviously go through some details, but what retirement, obviously, when we're working within the superannuation system, is trying to get as much money into super as early as possible. And so whether that is a concessional contribution, whether that's a non-concessional contribution, just getting as much money into super as possible. And it's really thinking about those stages in life. And, when I was younger, my huge focus was retirement and trying to get, and I lived in the US. So, tax laws are a little bit different around retirement accounts, but essentially the same, trying to get as much money as possible into those retirement accounts, because it then gave me more options in the future rather than catching up. And when we talk about compounding, and of course that is earning a return on a return, we always talk about compounding in terms of investing, but tax savings are also something you can compound. And so I put together this scenario. I'm a little bit jet lagged because I got back from the US on Monday morning. And so I woke up at 3 a.m. and went through this little scenario. So hopefully it's all right. But a little bit complicated. So let's assume you have $10,000 extra a year to invest. And obviously, if $10,000 seems too much or too little, it doesn't really matter, right? It's the concept that matters here. And so what we're assuming here is that you are making your mandatory contributions to super. You've got $10,000 a year extra. And what are you going to do to it? So I went through this scenario, and there's, I guess, some complicated rules to it, but I think it gets the point across. So the first thing is, all right, what are you trying to do? You are making pre-tax concessional contributions of $10,000 a year into super for 10 years. And you have this lifetime of options of when you're going to do this. So you can start doing that at 25, start doing it at 35, 45, and 55. And, what a lot of people do is, of course, and this is human nature, that when you are younger, you think, well, I have a really long time for retirement, so I'll save for retirement later. Now, obviously, you have to make mandatory contributions in the super, but you'll just put that off. Why would I save for retirement now when I'm 25? I'll deal with it later in life. All right, so you're putting them in, you are getting a 15% tax rate on your super contributions. And I went through two different marginal tax rates, because the other concept is if I have this $10,000, I could just save and invest it. And I could invest it in a obviously non-super account. And I went through two different marginal tax rates, which I'll show. You earn 7% a year in returns prior to taxes. And what I did as part of this model is I just said that you are paying taxes on obviously your contribution from a super standpoint, but also you're paying taxes in the fact that this is $10,000 a year pre-tax, right? So you have $10,000 extra in salary, you still have to pay taxes before you get it. So we are paying a full tax every year on that 7% that we make. And I've assumed long-term capital gains. Now, this isn't necessarily realistic, right? Nobody goes into an investment and sells it every year, although actually some people do. But either way, you're paying that tax. So whether I sit there and hold something for 5 years and get a 7% return, I'm assuming that return is smooth. Whether I hold that for 5 years or whether I do it for 1 year, doesn't really matter. I've assumed the long-term capital gains discount on this. But we can just think whatever that 7% return comes from, if it's dividends or capital gains, you're paying that tax. And then obviously what I'm assuming at the end is that at 65, you retire. And so you're then going into pension mode and you will not have any tax liability. And effectively, because of the way that I modeled this out, you will have no tax liability at 65 on that money in the taxable accounts. So hopefully everyone got that. I know that there's some complications. But basically, think about this. You are saving $10,000 a year pre-tax for 40 years. So between 25 and 65. And we're just looking at, if I put it into super at different stages of that life, what is the impact of this? So I created some stupid spreadsheet. And what I looked at is total wealth. So this is total wealth in your super account and outside of your super account. It's only from this $10,000 pre-tax. And looked at a 32.5% marginal tax rate. And then I looked at a 45% marginal tax rate. And really what this shows is, of course, the impact of foregoing those early contributions. So remember, you are saving the exact same amount of money. You are saving the exact same amount of money at different tax rates, 10 years into that super tax rate, and then 30 years into a non-super tax rate. All we're doing is switching around the timing. Are you going to make those extra contributions early to super, or are you going to make them later? And what you can see, of course, is that sort of this approach and this attitude of I'll worry about retirement later leaves you with less money. And that is because there's a compounding impact of those taxes that you are saving on. So saving on taxes early matters. And so that's really what we're trying to demonstrate here, or what I'm trying to demonstrate here. So you can see it is pretty significant. So even if you delay a decade and you don't start until you're 35, that's still a $100,000 difference. Right? So a pretty big deal. And then obviously, if you are at marginal tax, or if you're a higher marginal tax rate, that's almost a $200,000 difference. So something to think about. And really, by taking care of retirement first, it then gives you, not only is it better from a total wealth perspective, but then it also gives you opportunities to work later in life into trying to get to independence, which is really that last point around independence, that you have choice. And that choice can be working part-time. That choice could be that you want to move into a different profession that perhaps is more aligned with what you're passionate about, where the pay isn't as good. Perhaps you want to retire early. All of those mean take care of retirement, and I'm talking about from your concessional age. So let's call it 65. I know it's a little bit different based on when you were born. We'll call it 65. Taking care of that retirement part of your life first. And that can really lead you to then give yourself the financial freedom to make different choices. So something to support. I think we got a lot of comments in chat, so I'll pause and read those. Okay, so Dan says retirement. What percentage of people do you think actually overestimate what they need in retirement and take on too much risk? Listen, what I would say is the percentage of people that do it from an overall, if we look at overall society, is probably pretty low. I think if we're looking at, and listen, this is an opinion, I think that if we are looking at perhaps wealthier individuals that are more focused on saving and investing, I bet you it's actually pretty high. And, I think that, as we spend more time, and I know I do this, as you spend more time kind of focusing on investing and savings and coming up with a financial plan, I think there's a lot of different opportunities where you can sit there and come up with just scenarios where you need to save money, and that there are people that are too conservative. I'd say that's probably a better outcome than the alternative. And all of a sudden waking up and being 65 and realizing you don't have enough to pay for your retirement. But yeah, I think it is a problem. The issue, of course, that we run into with retirement is we have no idea how long we're going to live. And I think that kind of impacts our mentality. So, if somebody told me the day that I was going to die, which I'm hoping is not today, but if somebody came out there and told me that, then it would be a lot easier for me to plan. All right. I don't have to start having these scenarios in my head of what happens if I live to 99 years old? Right? Even if we all just died at the average age that people die, that would make things a lot easier from a retirement planning perspective, at the very least. But yeah, there's certainly a lot of people that are amassing a lot of money within super and die with a significant amount of money, perhaps even more than they want to pass on to their heirs or charity or anything else. So yeah, I think that is certainly something that happens to a fair amount of people. So Lisa says, so you're advocating for savings directly into super rather than savings outside of super, depending upon your marginal tax rate. So I don't know if you finished your thought. Maybe you're saying so. So is what you wrote at the beginning. You're not calling me S. That's like Gossip Girl. It's probably dating myself. Emily is, anyway, it's a character on Gossip Girl. I'll be quiet about that now. What I'm advocating for is I'm advocating that over a lifetime, if you want to save money outside of super, and there's a lot of really good reasons to do it, what I'm saying is that should be a secondary goal of yours. Try to get as much into super as possible when you're younger, and then benefit for that. So if we look at our life, and I know we're always in a hurry to do things, but if we look at all our life, let's kind of work backwards. Right? Like obviously establish an emergency fund, but then work backwards, right? Let's take care of retirement. Try to take care of retirement as soon as possible. And then, work our way backwards into, okay, now maybe I have the opportunity to retire early or the opportunity to cut back to a part-time job or go into a different profession and kind of work your way back. So I think that human nature is we tend to like focus on immediate goals. And, I know when I was younger, I was very focused on retiring early. But when I thought about this, I thought, okay, well, the best way I can do that is to finish retirement first, right? I can't retire if I'm not going to have enough money when I'm 65. So that's really like, I think what the math tells you. There's a lot of advantages to saving money outside of super, right? If we think about what super is essentially what we are getting a very favorable tax benefit, but there's a bunch of rules we need to follow, right? And the number one rule is, of course, when you can access your money. So we just need to realize that we're exchanging that tax benefit for something else. So I think it makes a lot of sense to save money outside of super, depending upon what your life goals are. So you don't have all those restrictive rules, but we all need money in retirement. So take care of that retirement first. Okay, so John's saying, what about the value of the dollar? $10,000 at a later age has to be scaled to the equivalent, in which case actual differences are not so much. I.e., you'd be putting $20,000 instead of $10,000 to have same value. Okay, so yes, there is 100% going to be inflation, which is going to reduce the value of the dollar. But really what I'm trying to say on this slide is, in this case, and I will say in this sort of model that I put together, if we want to call it that, I did not in any way assume that you would be spending the money. So in both cases, this money is just accruing, some of it in a tax advantage situation and some of it just at a marginal tax rate situation. So either way, this is how much money you would have at 65. Right. So even though inflation is going to reduce this and reduce the buying power of the money, still $1 million is better than $920,000. Right. So no matter what. Now, obviously, you could spend that money earlier, and we're going to talk about that on the next slide. But either way, even though $1 million when you're 65 is not $1 million now, unless you're 65, either way, that is more total wealth that you would have. So Daniel says, I'm planning on living 25 years. Okay. That's maybe somebody told Daniel when he was going to die. But I'm planning on living 25 years and plan on still holding at least a 70-30 portfolio. My financial planner had kittens when I told him that, but the math stack up if you can hold your nerve. Yeah, I mean, listen, more and more people are increasing their allocation to shares. And there was an article in the Wall Street Journal the other day just talking about it. But traditionally, what the sort of cardinal rule is that your asset allocation should reflect your age. So basically, at the end of the day, the amount that you were supposed to hold in fixed income was supposed to be your age. So, you're 65 and you hold 65% of your portfolio in defensive assets like bonds and cash. I would say for the most part, that is kind of out the window. It's out the window, first of all, because it's a lower return environment, has been for a while for bonds and cash. Of course, as interest rates are lower than they've traditionally been. And it's also out the window because people are living longer. And so, yeah, I agree that it's completely about holding your nerve. Because as long as you still have that long time horizon, perhaps if you set yourself up with a little bit of a bucket portfolio to protect yourself from the volatility of shares. That's where cash can be really valuable because it can protect you from that volatility. Everything from an emergency fund to the bucket method. If you put in some of those safeguards, then yeah, I would say you can certainly go out there and as long as you still have a relatively long timeline, go out there and invest more aggressively. So Greg says, is your $10,000 per year salary sacrifice on top of normal super contributions? It is. So basically saying you have $10,000 extra and you have $10,000 extra pre-tax. So remember, so that's just saying that, okay, if I want to invest that super, they're going to take 15% of that, right? If I put in that concessional contribution in the super, if I take that $10,000 and I put it into an investment account, I still have to pay my marginal tax rate, right? Because it's pre-tax. So it's the only way I could model that additional benefit of obviously what you're taxed on what goes into super is less than marginal tax rates. Tony says, what about the pension asset test? Taper trap, not worth saving too much from a cash flow point of view, better spend and maintain lifestyle. Yeah, listen, the pension asset test is something that is obviously very, very much based on personal circumstances. And of course, what we're talking about there is that the more cash or the more money you have outside of your primary residence, that's going to impact your ability to qualify for a pension and how you qualify for it. So if you are in a situation where you are very close to that, then yeah, it certainly potentially makes a lot more sense to go out there and spend more money and kind of reduce those asset levels or put it in your house or whatever. But yeah, it's kind of if you are sort of marginally there. If you have significantly more money than to ever qualify for the pension, that's not really a concern of yours. If you have significantly less money and you're always going to qualify for the pension, not a concern for you as well. But it's a good point. So Lisa says, what I did is I retired with half assets, set my home outside super and half assets and super. We're going to talk about that in 1 second, Lisa. So if you have some assets outside of super within a family trust, then you can distribute up to $18,000 tax-free to yourself and your spouse, total $36,000 per year tax-free outside of your super. What are your thoughts around this? I'm hesitant to put everything into super as the government changes rules and control of your funds. Super is an absolute if the government can change the rules. Okay, so very, very, very good point. So, when I made that point around, that you are effectively exchanging a beneficial tax situation by putting money into super for a bunch of set of rules. I should have added that those rules can change. And I think and I know a lot of people that watch these webinars and a lot of people that have written to me are very frustrated about this. And all we really want as investors and all I think any business really wants, and frankly, what most people in society want is consistency of rules. So it is very, very difficult that, I'm 44 now. It is a difficult situation of putting money into a super account when I don't actually have any idea what the rules are going to be when I retire. So that is a very difficult situation. I think you need to make a decision on what are the likelihoods of significant rule changes that are going to impact you versus that tax benefit. The tax benefit is significant. But, at the end of the day, when governments need money, where do they go? Well, they go where the money is. And where's the money in Australia? Well, the money is in people's homes and the money's in super, right? Those are the two giant piles of money in Australia that governments can go at, that the government can go after. So there is always a risk that super rules, and there's a history of super rules continuing to evolve. So yeah, that's a risk. And I think it's thinking about, the likelihood of those rules and if they'll impact you. So, as we sort of saw with the super changes that were announced relatively recently, around the $3 million balance, I think you need to think about sort of where your super balance is or where it's projected to be, because chances are, of course, they're going to go after the largest money accounts if they want to raise tax revenue. And yeah, it can be an issue. Emma says, what services does Morningstar provide? Do you provide similar services to Macquarie? You said some funds. Yeah, so Emma, I'll spend 30 seconds. We basically provide investment research. We have a subscription service where you get access to our analysts that provide research. We do manage money, but we do it through advisors. So you would have to go through a financial advisor. But you can send me an email at mark.lamonica1@morningstar.com, and I can expand on that. Okay, really good question from Stu. Sorry if I pronounced that wrong. I have a disability and likely won't be able to work until I'm 65. So I just continue investing out of super. Yeah, I think you need to look very specifically at the rules then on early access to super if you are unable to work. So it's certainly not something I can give you advice on I shouldn't give you advice on anyway, but don't know the details. But there are certain ways that you can access money in super prior to your preservation age. So I would look at what those rules are and the likelihood that you would qualify for those rules. So yeah, that's something important to look at. Sorry, all right, I'll go through a little more of this and I'll get to the rest of the questions, I promise. Okay, so now let's look at the next step. And we'll talk about, and this should say, how do we gain independence during the quote unquote working years? So what I'm talking about in terms of working years is before your preservation age, right? So let's say it's 65. How do we kind of gain that independence that one of those comments was talking about, where really independence is being able to do what you want, right? The tell your boss to go take a hike theory of independence, or, creating or working part-time or changing careers, everything I talked about. And there's two challenges with this. The first one, of course, is that superannuation and amassing all your assets in superannuation. We can't touch it until we make preservation age or when one of these rules applies to us. The second problem that we have, and I've done webinars on this before, is that traditionally, of course, when we think about retirement planning, it's around this withdrawal rate. I won't go through all the details, but how much can I safely take out of my account and have it last until I die, when I don't know when I'm going to die, and I don't know the order of returns and the average return I'm going to get. So the other big challenge we have here is that we cannot simply, as the FIRE movement talks about, that's financial independence, retire early, we cannot simply take the 4% rule as they took and say that it applies if we retire at any time. As long as we have enough money to support our spending needs on 4% of that money, we can't retire at 25 because we will run out of money. So that withdrawal rate is very specific to a retirement time frame of 30 years, which is supposed to cover that longevity risk, right? And if you live past 95 and retire at 65, well, I don't know what to tell you then, but that was very much what this withdrawal rate was around. So we can't sit there and say that we'll retire 20 years before that, right? So those are the two challenges we have kind of building this independence. And there's sort of two different ways that you can look at this. The first is to create a pool of money outside of super that can act as a bridge, right, to when you get to your retirement savings. So this is assuming that we have checked that box around retirement savings. So we are comfortable with whatever, and we'll assume we're just walking away from work and retiring early. But it can also apply to any of the other situations that I talked about. We have to assume that we are comfortable, that we have enough money that by the time we're 65, it will be able to support our retirement. So then really what we're thinking about is, if we're talking about early retirement, what is that bridge, right? From when you stop working until you're 65, if you are confident you have enough money. And, you know, the one way we can think about this is, and I'll go into some more detail, but this is very short term, right? So, okay, if I'm going to retire at 50, I've got 15 years. So I've got 15 years. I need enough money to support me for 15 years. And if I draw that down to zero, that's fine, because then my super kicks in and then super will pay for me. Second one is, do we want to create a sustainable stream of income that will last beyond 65? Right? So this is kind of like super plus, right? So I've got my super, I've hopefully got retirement taken care of. Now I've got this stream of income. And what can I do with this stream of income? Well, it can allow me to supplement my life. All right. So if I want to keep working for the same salary, don't want to change anything, this allows me to have some extra money that I can, whatever you like to do, go out to dinner more, travel more, whatever you want to do. Gives us something to give ourselves a better lifestyle, however we define that. The other thing it can do, of course, is it can allow you to work part-time. Right? So if I can create an income stream that gives me 20% of my salary, well, then all of a sudden I can work 4 days a week. All right, maybe that's really what you're looking for. Allows us the flexibility to move into a lower paying job that, as I said before, maybe aligns with our passion and our interest. So this is a little bit different. We'll talk about the details. I'll just go into those. Okay, let's talk about the first one, this bridge to your preservation age. And so basically, I listed a couple of things. A couple of things to think about is, if we don't really care if this money, this pool of money exists when we get to 65, we're confident about our retirement. So if we don't really care, then of course we can use a more aggressive withdrawal rate. And so, and what this means is I'm just collecting some income, but selling off assets every year to take out a percentage of income. And we have to remember that a withdrawal rate, the safe withdrawal rate, the reason safe is in there is because what it's supposed to cover is those outlier scenarios. And those outlier scenarios are, one, the market drops significantly just as you retire, because that's very bad. That's sequencing risk, right? So it's supposed to cover really poor and unlucky market conditions, that the market drops immediately as we're starting to pull money out. It covers longevity risk. So that is the risk that you live till you're 112 and you're in the Guinness Book of World Records. So it's supposed to cover that scenario as well. So we have to remember that, this isn't a magic formula. When we say the 4% rule is supposed to last 30 years, we're saying, okay, well, that's the scenario it's supposed to cover. That doesn't mean that you get to $0 after 30 years. In some cases, you might run out of money before. But most cases and most market combinations that we've seen historically, we don't know what's going to happen in the future, you would still have a fair amount of money when you hit 95 years old, or you'd have some money. So we just have to remember it's all kind of probability based. And probabilities are great when we're dealing with large pools of people. They're not great when you're just dealing with yourself, because you don't know when you're going to die. You don't know the market returns you're going to get. So a couple of things that we need to think about. We can use a more aggressive withdrawal rate because, of course, generally that time frame will be shorter unless you're trying to retire really early, right? So if you're trying to retire at 35 and trying to make it to 65, maybe we have to use the same withdrawal rate. We can use a significantly higher withdrawal rate, which we'll talk about. And that does not mean that you will be out of money, but you need to be prepared that you'll be out of money at 65, right? Depending upon that withdrawal rate you use. The other thing that this allows you to do is that, of course, retirement spending is not smooth. So everyone's circumstances are unique, but generally people spend a lot more money early in retirement. And they do this because that's when they're in the best physical health. And so they go out and do all the stuff that costs money. So whether that's travel and eating out and whatever else you like to do, people tend to slow down as they get older. So the highest cost periods of retirement are generally early in retirement. It's incidentally also the worst time to take money out of your super account because, of course, you then have a smaller pool to grow after that. So you do need to think about that. The other thing you need to think about is taxes. So the 4% rule and every other rule around retirement is assuming that that 4%, you are not spending that 4%. That 4% is what you can take out of your account, not the quote unquote take home pay from your account. Now, in Australia, this doesn't matter because, of course, if you're in the pension phase, you pay no taxes on withdrawals. So the 4% rule works very well. I have $1 million, I take out $40,000 a year. That $40,000 is in my bank account. I spend that. But that is not true if your assets are outside super. So remember, you have $1 million, you take out $40,000 a year, then you pay taxes on that $40,000. And obviously, depending upon what that number is and where you fall in a marginal tax rate perspective, all of a sudden you have less money to spend. So you do need to think about taxes. And you can't just think that 4,000 or 4%, if you're using that as a withdrawal rate, is the money you get after taxes. It's not. It's the money you get before taxes. So you do need to consider taxes. Now, the issue with this is depending upon this withdrawal rate during this bridge period, depending upon what this is, aggressively spending down those assets obviously can put your retirement at risk or lead to a different lifestyle in retirement because we don't know the returns we're going to get. We don't know the environment we're going into as retirement. I mean, this is just the whole adage that having more money, of course, is safer than having less money. So it is just something to think about. What we're looking at here is we're looking at withdrawal rates. I'm not going to go through the asset allocation piece unless people have questions around it, but this is looking at 30 years of starting safe withdrawal rates and looking at different time periods as well, from 10 years to 40 years. Looking at safe withdrawal rates at a 90% probability. So that is a 90% probability based on historic market returns, 90% probability that you will not run out of money before the end of that time period. So what you can see here is you can see from a withdrawal rate perspective that if it's a shorter time frame, right, with 10 years, you can take out a lot more money. Now, the only comment I will make on this chart, because people might be confused about this, and obviously the longer you need the money to last, the less money you can take out. Why you're probably sitting here looking at 10 years is why, if you have 100% equity allocation, is the safe withdrawal rate 8.5%. But if you put all your money into cash, you can take out more. Why is that? It's because of volatility, right? Because if all your money is sitting in cash, then of course, and this does include inflation when you're taking out the money. That's why this is not 10% for 10 years. There's a bit of inflation baked into this. If all your money is sitting in cash, you know exactly what it is, right? So over 10 years, you just take a tenth out every year, right? Now, in this case, obviously, there's a little bit of inflation. You're increasing those withdrawals by inflation. But that's really why this is higher than that, just so people know. But as you can see, the shorter the time period, the more money you can take out safely. And once again, this is a 90% probability rate. If you were to reduce this, of course, those withdrawal rates go up. So just something to think about. All right, so let's talk about this other one, this sustainable stream of income. And I will say this is kind of what I'm doing in my own life. Not that you should use me as an example. So same things. So what can you do? Early retirement, part-time work, career shift, enhancing your lifestyle. There are some challenges around doing this. And the challenges, of course, and this is basically the premise of this, is that we have this pool of money, it sits outside of super, and I just live off the dividends, or I'll either live off of, or I use the dividends to supplement my life. Now, the advantage of this, of course, is that you are not selling off any assets. So in theory, you don't run out of money. I guess, well, in a practical sense, you don't go out of money. Now, what would be volatile then potentially is the money you're taking out every year, because if dividends go down, then you take out less money. But that's really the premise here, because I'm never selling any of the principal. So I'm never selling those shares that I hold or those bonds that I hold, never selling them. I'm just living off of that interest, those dividends, the distributions from an ETF. I'm never technically going to run out of money. So I always have that money. And that money is, of course, working for me and throwing off cash that I can spend. And this was very attractive to me when I was younger, because I thought this is the perfect formula, right? Like it gets rid of all of these problems of retiring early around longevity risk. The issue, of course, is you need to have a lot of money, and you need to have a lot of money earlier in your life. It's much easier to have a lot of money at 65 than it is at 45, right? Because you're missing out on those 20 years. Your returns are going to be lower, right? Because you're not reinvesting any of those dividends. You're pulling them out. So your returns will be lower, but you're not going to run out of money. You just have to figure out how to get enough money to support whatever your goal is around independence. So if it's early retirement, then that's probably the most money. If it's part-time, as I said, well, replace 20% of your salary, you take a day off. And there's three real challenges, and these are challenges I face. Originally, I wanted to retire at 50, and I just wrote an article on this actually. So it's a little bit front of mind. The one is kind of this law of big numbers. So when I was younger, I sat there and I didn't have much money. So it was very simple for me to grow my dividends, grow my income stream at really high percentages, right? So, and the reason I was able to do that is because I was contributing money that at the time was relatively large compared to my portfolio, right? So if you have a $50,000 portfolio and you're saving $10,000 a year, well, initially that's a lot, right? Because you are putting in 20% of your portfolio every year. And I was using that to buy dividend shares, and it grew my income really quickly. And what I eventually found is, of course, as the numbers get bigger, this is harder to do. And it's harder to do because if your portfolio is not $50,000, if it's $500,000, even if I double or triple or quadruple the amount that I'm saving, it's still a lot smaller percentage of that pool, which means that in terms of growing my income by a percentage, a lot less of it is coming from new shares that I purchase. And so I'm forced to rely on dividend increases, and I'm forced to rely on dividend reinvestment to buy more shares. So you do run into that problem. It can be at different time periods for different people. Taxes are an issue. And taxes are an issue because what that's going to do is, of course, depending upon how you think about it, sort of mentally compartmentalize the way that you pay your taxes, you either have to pay your taxes out of the dividends you earn, right? So you get paid your dividends, you're in that 45% tax bracket. Well, all of a sudden, almost half of it has to go to pay taxes, or you have to save that money somewhere else to pay your taxes. So that can be a real challenge you face to a lesser extent in super because the taxes are lower. And the other problem you kind of run into is that, like, people generally sort of run into this lifestyle creep issue. So basically meaning that, as you get more raises and make more money, people seem to adjust their lifestyle. People do. They adjust their lifestyle up to a bare minimum. right? So everyone can sit back and talk about, oh, it was great when I was in uni and had no money and I ate toast for every meal. Yeah, you can romanticize that, but all of a sudden people increase their standards, and potentially very high standards become that bare minimum that you will accept in your life. And so it is hard to hold that back. And what that does is it basically, as your lifestyle gets more expensive, then of course it increases the amount of money you need to retire early, or even to move to a job where you don't get paid as much or work part-time. So it's really important to try to control that, because it's kind of this issue that we run into. We always hear that joke, right, about somebody who wants to maintain the lifestyle they've grown accustomed to. Well, that's lifestyle creep. All right, so I'm going to spend some time answering some questions. So the anonymous attendee, but what if I want to retire at 55? I don't have access to money until 67. Wouldn't investing be better? Yeah, so that's kind of the point I was making. All I am saying is that all I was saying, to kind of reiterate, is that if you want to retire at 55, the order of your savings, save in super first when you're younger. I'm not saying you don't save outside of super. That was not the point. Remember, in every one of those scenarios I ran through, it was a 40-year time period. All I was saying is 10 years of saving extra in super. And that obviously changes based on what you're trying to do. But so 30 years of that was saving outside of super. It was just occurring at different time periods over your life. And I was just saying, save in super first, because at least as the taxes are structured now, it's a big advantage. So Wilson says, I'm 55 years old and only recently returned to Australia for early retirement after working overseas for 22 years. Welcome back. I have only $10,000 in my old super account. I currently have $800,000 invested, 5-year term deposit earning an average of 4.5% return. I also have rental income from investment property. How can I save on tax? Would you recommend me putting money into this old super account? Okay, so there's a couple different considerations. Like number one, as I kind of talked about, the fact that you are, and this obviously is not tax advice, you should consult a tax professional. Because you're 55 years old, of course, that advantage you get from being in super is lowered, but it could still be significant. And it could still be significant in terms of the fact that you could live a very, very long time once you reach your preservation age. So yeah, I would think about that. I would think about how much you need right now to support yourself from 55, in your case, from 55 to 67, how much you need to support yourself during that time period. If you can come up with that number, then the money would be better in super. And there's, well, because this money is in term deposits, you don't have to worry about a lot of big unrealized capital gains. The money would be better in super. So think about what you need to get to super. And just remember, as soon as you get into that pension phase, right, then the taxes are not 15%. The advantage is the taxes are zero. So that's zero on capital gains, zero on dividend income you earned. It's a huge advantage. So yeah, I would certainly do that. And Wilson's saying, what kind of investment should I select for my super account? If your answer is yes, which I guess it was, when can I access the money from super accounts since the government seems to keep extending the retirement age? Yeah, the government is extending the retirement age, but they are extending it based on certain dates. So if you go back and you look at the actual preservation age or retirement age, it is based on when you were born. So they're not actually extending it for anyone. They're not going up to a bunch of 65-year-olds and being like, hey, guess what? You can't retire until you're 70 now. What they're doing is they're going and they're extending it for younger people. So I would just Google, I just don't want to get the numbers wrong. I would just Google preservation age. And there's all sorts of different charts that will show you if you were born before this date, this is your preservation age. So yeah, I would not see any government extending the retirement age for someone who's 55. Adam says, modern thinking says bonds are useless, and I'm planning on keeping 100% exposure to equities. Yeah, I mean, hey, I don't, this is not advice. I don't personally have any bonds. I have a hard time figuring out with the ways that I can access bonds as an individual. I have a hard time figuring out why it's better than cash. That's a whole different story, but right, modern thinking says bonds are useless. That's a really good quote. Okay, so Paul's saying, what if you have exceeded your max contribution base? Okay, well, if you have exceeded it, there's a couple things that you can think about. One is you can think about non-concessional contributions, right? So concessional contribution is, there's one limit for those, and you can look back on other years and increase it. There's all sorts of different things you can do. I can send you that information if you want. You can also make non-concessional contributions. So basically you're not getting that tax advantage going in, but the money is then in an environment where there's a better tax, structure. And that's a little trickier, right? So it's a little different than that model that I ran. So you're paying sort of your full marginal rate on the money, then you put it into super, then it's in a better environment. So it kind of depends upon your own situation, but that's also an option you have. All right, so anonymous attendees, do you think Australian term deposits like Judo Bank, which I can't say that I've heard of, but I like the name, will go to 6% by August and fall after that? Okay, so this is obviously all around interest rates, and I will very quickly, I think the market expectations are that interest rates will continue to go up. I would expect to see term deposits continue to go up. The issue you have with the term deposit, and as I say, I keep my money in cash and term deposits. The issue, of course, that you have is you have that rollover risk, right? I can get a better rate from ING, which is the bank I use. I can get a better rate on a term deposit than I can get from an Aussie government bond right now. The problem is that if I could buy a bond, the bond, not an ETF or a bond fund, the bond, I can buy a 10-year bond. I know that return I'll get for 10 years, right? There's no default risk. It's an Aussie government bond. I know that return. The issue is I go buy even a year CD, a year term deposit. I don't know what that's going to mature at. So yeah, I think rates are probably going to be higher than most people expect for a while. That's a personal opinion, but yeah, that's just me. Okay. Sorry, there's a lot of other questions. Why do you have to pay tax on money you have saved outside of super? You already paid tax on that money. You have to pay the tax on the returns. So that's really the issue. Yeah, if you keep it in cash, you're not earning a return, you don't have to pay taxes. But I'm talking about the tax you pay on the return. So if I make 10%, I don't get 10%, right? I sell that and I get a capital gains tax. If I get dividends, I am taxed on that as income. Janice says, can you share the chart? If you could just flick me an email, I will share the chart. Lisa says, in this withdrawal chart, are bonds included in equities or non-equities? Yeah, they're included in non-equities. So when it says equity percentage, go back to that chart. When it says equity percentage, 100%, that means it's all equities. 90%, 10% are in bonds. Daniel's saying I'm not retiring if I need to live on toast. I agree, but maybe you can throw a piece of cheese on there. It would help. Sorry, I'm trying to find. How can you shove your share profits into super to avoid higher tax? Yeah, I think the short answer is you can't. Hire a very good accountant. If you convert one of your accumulation accounts into allocated pensions, your total limit's at the one applicable. Okay, send me an email. Sorry, we're out of time on that one. Pravesh. Okay, most of these seem to be comments. Anyway, we're out of time. I'm sorry about that. But hey, anyone that wants to email me, mark.lamonica1@morningstar.com. I can send through this presentation if people are interested. If you have questions about my stupid income article, I can send that on, or just answer any other questions you have. So thank you for joining. Please email me. I'm happy to answer any questions. And yeah, thanks. I'll be back next Tuesday.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.